Have you ever stopped to ponder where money comes from? How is it that a piece of paper or a number on a screen holds such immense value? It's a question that's puzzled thinkers and economists for centuries. In our everyday lives, we tend to think of money as something tangible, something we can touch, feel, and count. When we imagine money being created, we often picture a mint where machines whir and churn, stamping out gleaming coins and crisp bills. Indeed, this is one way money is created. However, this is just the tip of the iceberg, a mere fraction of the entire story. The creation of money is not confined to the walls of a mint. It extends far beyond, into the realm of banks and financial institutions. Now that's a bit surprising, isn't it? After all, banks are where we store money, not where we create it, right? Well, the reality is a bit more complex than that. Contrary to popular belief, banks play an instrumental role in the creation of money. They don't just hold and distribute currency, they actively contribute to the money supply. Every time a bank makes a loan, it essentially creates money. This might sound strange, but it's a fundamental aspect of our financial system, one that's often misunderstood or overlooked. Now you might be wondering, how can a bank create money? Aren't they just lending out money that's been deposited by their customers? This is a common misconception, and it's not entirely wrong, but it's not the whole truth either. The reality is that banks can and do create money, and they do it every single day. It's part of what makes our economy tick, and it's a fascinating process that we're going to explore in more detail. But for now, let's just say that when it comes to money creation, banks are a lot more powerful and influential than you might think. But how exactly do banks create money? Hold on to that curiosity. Banks, often viewed as mere storehouses for money, are actually key players in its creation. Intrigued? Let's demystify this process. You see, when banks make loans, they are not merely lending out someone else's savings, but instead, they are creating new money. Let's take a step back and imagine a scenario. Suppose you deposit $100 into your bank. The bank doesn't just store this money in a vault, it uses most of it to make loans. So, your bank might then lend out $80 to someone who wants a loan. Now here's where the magic happens. When the bank does this, it doesn't actually take $80 from your account. Your original $100 is still there. And yet there's now an additional $80 in the form of a loan. In effect, the bank has created money. How does this work? Well, it's all about accounting. In the bank's books, your deposit and the loan it makes are both considered assets. The bank simply creates a new loan account, and voila, new money is created. But don't be fooled into thinking banks can create infinite amounts of money. There are rules and regulations in place to ensure that they don't go overboard. For instance, banks are required to hold a certain percentage of their deposits in reserve. This is known as the reserve ratio, and it's a tool used to control how much new money banks can create. Furthermore, the process of money creation also depends on people actually wanting to borrow money. If no one wants a loan, then banks can't create money this way. So in essence, banks play a crucial role in the creation of money. They aren't just places to store your cash, but active participants in the economy, creating and managing the circulation of money. Banks indeed have a magical touch that turns less into more. But what keeps this magic in check? Meet the puppet master of this whole operation, the central bank. Nestled at the heart of a nation's financial system, the central bank plays a crucial role in controlling the supply of money. It's akin to a conductor, orchestrating the symphony of economic activity with a baton of monetary policies. So how does it work? The central bank has an array of tools at its disposal. One of the key tools is the setting of reserve requirements. These are the minimum amounts of money that banks must keep on hand to cover potential withdrawals. By adjusting these requirements, the central bank can influence how much money banks are able to create. Imagine if the central bank decides to increase reserve requirements. This means banks must keep more money on hand. As a result, they have less to loan out, effectively putting a brake on money creation. On the flip side, if the central bank lowers reserve requirements, banks have more money to loan, stimulating money creation. But the central bank doesn't stop there. It also uses other tools, like open market operations and interest rates. Open market operations involve the buying and selling of government bonds. When the central bank buys these bonds, it essentially pumps money into the economy. When it sells, it does the opposite, pulling money out. Then there's the interest rate. This is the cost of borrowing money. When the central bank raises this rate, it becomes more expensive for banks to borrow. This discourages excessive lending and reins in money creation. Conversely, when it lowers the rate, borrowing becomes cheaper, encouraging more lending and promoting money creation. The central bank, therefore, is the guardian of the economy. It keeps a watchful eye on the money supply, ensuring it aligns with economic stability. It uses its tools to prevent banks from creating excessive amounts of money, which could trigger inflation or other economic problems. The central bank, thus, ensures the balance between money creation and economic stability. As we move into a digital age, the way money is created is also evolving. Are you ready to delve into the future? In this new epoch, we're witnessing the rise of digital currencies and digital transactions, both of which are dramatically altering the landscape of money creation. Just as the internet revolutionized communication, the digital age is now revolutionizing money. Let's start with digital transactions. Nowadays, most of our transactions are digital. We shop online, we pay bills online, we even transfer money to our friends and family online. This shift from physical to digital transactions has a profound impact on how money is created. Instead of printing more physical cash, banks now simply adjust the numbers in their digital databases, a process that's faster, more efficient, and less resource-intensive. But digital transactions are just the tip of the iceberg. The real game changer is the advent of cryptocurrencies, a completely new form of money creation. Unlike traditional money, which is issued and regulated by central banks, cryptocurrencies are decentralized and governed by complex algorithms. Take Bitcoin, for instance. It's created through a process called mining, where powerful computers solve complex mathematical problems. Once a problem is solved, a new Bitcoin is created and added to the digital ledger known as the blockchain. This process is not controlled by any central authority, making Bitcoin a truly global and democratic form of money. Cryptocurrencies like Bitcoin represent a paradigm shift in the world of money creation. They challenge the traditional banking system by offering an alternative that's decentralized, transparent, and potentially more secure. But as with any new technology, cryptocurrencies also come with their own set of challenges. Their volatile nature, regulatory issues, and the potential for misuse are all concerns that need to be addressed. However, one thing is clear. In the digital age, money creation is no longer the sole domain of banks and central banks. The future of money is here, and it's digital. From physical currency to digital numbers, the creation of money is a fascinating process, isn't it? We've journeyed from the enigma of money creation to the intricate web of banks and central banks, and finally, to the dawn of the digital age of money. Let's take a moment to revisit the key points we've discussed. In the beginning, we explored the mystery of money creation. We learned that money, in its most basic form, is a medium of exchange, a unit of account, and a store of value. It's a concept so simple, yet so transformative, that it has shaped civilizations and driven economies. We then moved on to the role of banks. Far from being mere storage facilities, banks are instrumental in the creation of money. Through the process of lending, they effectively multiply the money supply. This is known as fractional reserve banking, a system where banks are required to hold only a fraction of their depositors' funds and can lend out the rest. Our journey then took us to the doors of the central bank, the institution at the heart of a nation's financial system. The central bank controls the money supply, setting interest rates and using tools like open market operations to influence the economy. It's the central bank's role that ensures the stability and integrity of a country's currency. Finally, we delved into the digital age of money. In this era, money is no longer just physical notes and coins. It has evolved into digital numbers, stored in electronic databases. Cryptocurrencies like Bitcoin have emerged, challenging traditional notions of money and banking. Each step in this journey, from the creation of physical money to the rise of digital currencies, is a testament to our capacity for innovation and adaptation. As we've discovered, the journey of money creation is a complex yet captivating one. It makes one appreciate the value of every penny, doesn't it?